Listen carefully because what I'm about to share with you isn't being discussed in mainstream financial media. While everyone's distracted by stock market headlines and crypto volatility, something unprecedented is happening in the precious metals market that could determine whether your wealth survives what's coming next. Right now, at this very moment, there's a massive disconnect forming between paper metal prices and physical metal availability. And if you don't understand what this means for your financial future, you could wake up one morning to find that the wealth you thought you had simply doesn't exist anymore. Let me paint you a picture of what's actually happening behind the scenes. Major bullion dealers across North America are reporting something they've never seen before. Customers are placing orders for physical gold and silver, wiring six-figure sums, and then being told their delivery will take 6 to 8 weeks, not days, not even a couple weeks, 2 months, for a product they've already paid for in full. Now, you might be thinking that's just a temporary supply chain issue, but here's where it gets interesting. At the exact same time these delays are happening, the paper price of gold and silver on the COMEX Futures Exchange is being suppressed through massive short positions. Think about that for a second. Physical metal is so scarce that dealers can't fulfill orders for 2 months, yet the paper price suggests there's plenty of supply. Something doesn't add up, does it? This is the critical distinction you need to understand. When you buy a gold ETF or a futures contract, you don't own gold. You own a promise, a piece of paper that says you're entitled to gold. But here's the uncomfortable truth that's about to become very relevant. There are far more paper claims on gold than there is actual physical gold to back them up. It's the same fractional reserve game the banking system plays, except this time it's with precious metals. The COMEX, which is the primary exchange for precious metals futures in the United States, operates on a system where only a tiny fraction of contracts ever result in physical delivery. Most traders are just speculating on price movements and settle in cash. The exchange counts on this. They've built their entire operation around the assumption that physical delivery will remain the exception, not the rule. But what happens when that assumption breaks down? What happens when a significant percentage of contract holders suddenly demand physical metal instead of cash settlement? The system isn't designed to handle that scenario. There simply isn't enough physical metal in the vaults to satisfy those claims. We're already seeing the early warning signs. In recent months, the amount of gold leaving COMEX vaults has accelerated dramatically. Registered gold, which is the metal actually available for delivery against futures contracts, has been declining, while eligible gold, which is just being stored there, has been relatively stable. This tells us that the people who understand what's happening are taking their metal out of the system entirely. Central banks understand this better than anyone. They've been net buyers of gold for over a decade now, but the pace has intensified dramatically. We're talking about hundreds of tons being accumulated annually by countries that are actively working to reduce their dependence on the US dollar. China, Russia, India, Turkey, Poland, Singapore. These aren't random countries making random decisions. This is a coordinated shift away from dollar-denominated assets and into hard assets that can't be printed or devalued by a central bank. The Chinese central bank has been particularly aggressive. They've been reporting monthly increases in their gold reserves, but many analysts believe the actual accumulation is far higher than what's being officially disclosed. Why would they hide it? Because if the market knew the true extent of their buying, it would drive prices up before they've finished accumulating. This is strategic positioning for a post-dollar world. Russia took an even more dramatic step. After facing sanctions, they essentially de-dollarized their entire reserve system and shifted heavily into gold. They went from holding significant U.S. Treasury bonds to holding almost none, replacing them with physical gold stored in vaults they control. That's not a hedge. That's a complete rejection of the dollar-based system. Now here's where this becomes personal for you. If you're holding wealth in traditional financial assets, stocks, bonds, even cash in a bank account, you're exposed to the same system these central banks are actively moving away from. Your wealth exists as digital entries in a computer system that's built on layers of debt and promises. When confidence in that system wavers, those digital entries can evaporate faster than you can react. Physical metal is different. It's not someone else's liability. It's not a promise. It's a tangible asset that's been recognized as money for thousands of years across every civilization. When you hold a gold coin in your hand, you're holding something that has intrinsic value independent of any government, any bank, or any financial system. The wealthy have always understood this. Old money families, the kind that have preserved wealth across generations, have always maintained a significant allocation to physical precious metals. not as an investment to trade in and out of, but as a permanent foundation of their wealth structure. It's insurance that actually works when you need it most. But there's a critical window of opportunity that's closing. Right now, you can still acquire physical metal, even if you have to wait a few weeks for delivery. The system is strained but still functioning. However, if we see a major financial crisis, a currency collapse, or a geopolitical event that triggers a rush into physical metals, that window could slam shut overnight. Imagine trying to buy physical gold during a banking crisis when everyone else has the same idea. The premiums would skyrocket. Dealers would run out of inventory completely. You'd be competing with thousands of other people who suddenly realized they needed to own something real. At that point, price becomes almost irrelevant because availability becomes the constraint. This is exactly what happened during the early days of the pandemic. When markets crashed and uncertainty spiked, physical gold and silver premiums exploded. Silver coins that normally sold for a couple dollars over spot were suddenly commanding premiums of $8, $10, even $12 per ounce. And that was just a preview. That was a relatively mild crisis compared to what a true currency crisis or financial system breakdown would look like. The smart money isn't waiting for that scenario to play out. They're positioning now while physical metal is still available at reasonable premiums. They understand that the time to buy insurance is before you need it, not after your house is already on fire. Let's talk about what's driving this urgency right now. The global debt situation has reached levels that are mathematically impossible to resolve through normal economic growth. The United States alone has over $33 trillion in official debt, with unfunded liabilities that push the real number into the hundreds of trillions. There's no scenario where this debt gets paid back in dollars that have the same purchasing power as today. The only way out is inflation. Devaluing the currency so that the debt becomes easier to service in nominal terms, even though it destroys the purchasing power of everyone holding dollars. This isn't a conspiracy theory. This is basic mathematics and historical precedent. Every major empire that's accumulated unsustainable debt has eventually debased its currency. Rome did it. Weimar Germany did it. Zimbabwe did it. Venezuela is doing it right now. The difference this time is that we're talking about the world's reserve currency. When the dollar loses its privileged status, and that process is already underway, the implications are global. Countries that have been forced to hold dollars as reserves will dump them. International trade that's been denominated in dollars will shift to other currencies or direct barter arrangements. The demand for dollars will collapse while the supply, thanks to years of money printing, is enormous. What happens to dollar-denominated assets in that scenario? Stocks, bonds, real estate priced in dollars, all of it gets repriced lower in real terms even if the nominal numbers go up. You might see your stock portfolio hit new highs in dollar terms while your actual purchasing power declines. This is the inflation trap that destroys middle-class wealth. Physical gold and silver don't have this problem. They're not denominated in any currency. They're real assets with intrinsic value. When currencies devalue, precious metals don't lose value. They just require more units of the devaluing currency to purchase. This is why gold has maintained its purchasing power across centuries, while every paper currency has eventually gone to zero. Think about what an ounce of gold could buy in ancient Rome versus what it can buy today. The purchasing power is remarkably similar. You could buy a fine toga and sandals then. You can buy a quality suit and shoes now. Meanwhile, the currencies of Rome, the denarius and aureus, are worthless relics studied by historians. The gold is still valuable. This is the fundamental difference between real money and currency. Currency is a medium of exchange that derives its value from government decree and public confidence. Money is a store of value that maintains purchasing power over time. Gold and silver are money. Dollars, euros, yen, they're currencies. And throughout history, currencies always eventually fail while money endures. Now I want to address something important for those of you who have significant wealth tied up in retirement accounts. You might be thinking that you can't access that money without penalties, so you're stuck with whatever investments your 401k or IRA offers. But that's not entirely true. There's a structure called a gold IRA that allows you to hold physical precious metals inside a tax-advantaged retirement account. If you have $100,000 or more in retirement savings, this is something worth understanding. I've put together a free guide that explains exactly how this works, how to do it without triggering taxes or penalties, and what the requirements are. You'll find it in the description below. It's worth checking out if you want to protect your retirement savings with physical metal while maintaining the tax advantages. The reason this matters right now is because we're at a unique moment in the market cycle. Physical metal is still available. Premiums are relatively reasonable compared to what they could be, and most people still don't understand the urgency of the situation. That combination won't last forever. Let me give you a specific example of how fast things can change. Back in 1980, when gold hit its previous inflation-adjusted high, there was a period of just a few weeks where the price went parabolic. People who had been accumulating physical metal for years suddenly found themselves with massive gains. But more importantly, people who waited until the mania phase found themselves unable to buy physical metal at any price. Dealers were completely sold out. The only gold available was at coin shows and private sales at enormous premiums. The same thing happened in 2011 when gold briefly touched $1,900. Physical demand overwhelmed supply. Mints couldn't produce coins fast enough. Dealers had waiting lists. And this was during a period when the financial system was still relatively stable compared to where we are now. Imagine what happens when we get a real crisis. When banks start failing, when currencies start collapsing, when the average person suddenly realizes that their digital wealth isn't as secure as they thought. The rush into physical metals would be unlike anything we've seen before. And if you're trying to buy at that point, you'll be competing with millions of other people who had the same realization at the same time. This is why the concept of physical possession is so critical. It's not enough to own gold through an ETF or a certificate. You need to actually hold the metal or have it stored in a secure facility that you control. Because when the system is under stress, the difference between owning a claim on gold and owning physical gold becomes the difference between having wealth and having a worthless piece of paper. The Hunt brothers learned this lesson the hard way in the silver market. They accumulated massive positions in silver futures, thinking they controlled a significant portion of the market. But when the exchange changed the rules and forced liquidation, their paper positions evaporated. If they had taken physical delivery and held the metal outside the system, the outcome would have been completely different. This is the vulnerability of paper metals. The rules can change. Exchanges can halt trading. Governments can confiscate or restrict. But physical metal that you possess is outside that system. It's yours in a way that no digital entry or paper certificate can ever be. Now, let's talk about silver specifically, because it has some unique characteristics that make it even more compelling than gold in certain scenarios. Silver is both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and countless other industrial processes. Unlike gold, which is primarily held as a store of value, silver gets consumed in industrial applications. This creates a supply dynamic that's extremely bullish for silver prices. We're mining less silver now than we were a decade ago, while industrial demand continues to grow. The above-ground stockpiles that existed for decades have been largely depleted. And unlike gold, where most of what's ever been mined still exists in some form, much of the silver that's been mined has been consumed in industrial applications and is effectively gone. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15:1. That's roughly the ratio at which these metals exist in the Earth's crust. But right now, that ratio is much higher, meaning silver is significantly undervalued relative to gold. When this ratio reverts to historical norms, and it always does eventually, silver will outperform gold by a substantial margin. For someone building a position in physical metals, this suggests a strategy of holding both gold and silver, with a higher allocation to silver for its greater upside potential. Gold is the anchor, the stable store of value. Silver is the leverage, the metal that could see explosive gains when the market dynamics shift. But here's what you need to understand about timing. We're not talking about trying to trade in and out of these metals for short-term gains. That's a fool's game that will get you shaken out at exactly the wrong time. We're talking about building a core position in physical metals that you hold through whatever comes next. This is about wealth preservation and positioning for a monetary reset, not speculation. The central banks know this. The ultra-wealthy know this. The question is, do you know this? And more importantly, are you going to act on this knowledge while you still can? Because here's the uncomfortable truth that nobody wants to talk about. The financial system as we know it is living on borrowed time. The debt levels are unsustainable. The currency debasement is accelerating. The geopolitical tensions are intensifying. And the gap between paper asset prices and real asset values is widening every day. When the reset comes, and it will come, The people who positioned themselves in physical assets will be the ones who preserve their wealth. The people who stayed fully invested in paper assets, trusting that the system will somehow muddle through, are going to experience a wealth transfer unlike anything they've ever imagined. This isn't about being pessimistic or fearful. This is about being realistic and prepared. Throughout history, there have been periods of monetary chaos and financial upheaval. The people who survived those periods with their wealth intact were the ones who understood the difference between real assets and paper promises. They were the ones who acted before the crisis, not during it. You have that same opportunity right now. Physical gold and silver are still available. The premiums are still reasonable. The system is still functioning well enough to facilitate purchases and delivery. But that window is narrowing with each passing day. Every major bullion dealer will tell you the same thing. Demand is increasing. Inventory is tightening. Delivery times are extending. These are the warning signs that precede a supply crisis. And once that crisis hits, once physical metal becomes truly scarce, the price will be the least of your concerns. Availability will be the constraint. So what's the move? Start building your position in physical metals now. Don't try to time the perfect entry point. Don't wait for a pullback that might never come. Begin accumulating physical gold and silver as a core holding that you plan to own for years, potentially decades. If you're new to this, start with recognizable coins like American Eagles or Canadian Maples. They're easy to buy, easy to sell, and universally recognized. As you build your position, you can explore bars and other forms that might offer slightly lower premiums. Store your metals securely, either in a home safe or in a private vault facility that you control. Don't leave them in a bank-safe deposit box, because in a crisis, banks can restrict access. You want your metals to be accessible to you at all times. And most importantly, think of this as insurance, not an investment. You're not buying physical metals hoping to flip them for a quick profit. You're buying them as protection against the very real possibility that the financial system we've all taken for granted could experience a crisis that makes previous crises look mild by comparison. The people who understand what's happening aren't asking whether they should own physical metals. They're asking whether they own enough. They're looking at their total wealth and making sure that a significant portion is held in assets that exist outside the financial system, that can't be devalued by a central bank, and that will maintain their value regardless of what happens to paper currencies. This is your moment to make that same decision. The information is in front of you. The opportunity is still available. The question is whether you're going to act on it, or whether you're going to look back months or years from now and wish you had moved when you still could. Physical metal is your survival tool because it's the one asset that maintains its value when everything else is falling apart. It's been true for thousands of years, and it's going to be true in whatever comes next. The only question is whether you'll have positioned yourself accordingly. The clock is ticking. The warning signs are flashing. And the window of opportunity is closing. What you do next could determine whether you preserve your wealth or watch it evaporate in the chaos that's coming. Choose wisely.